Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 40. I cannot believe we've already made it 40 episodes into this experiment, if you want to keep calling it that. But on today's episode, we're going to look at the first quarter. First quarter's over, so let's review what's happened in the stock market. It's been a crazy first quarter. And also think about our goals. You're a quarter through the year, so how are those goals coming along? That's what we'll be covering on today's podcast. So I hope to see you on the other side. Let's get to work. Well, thanks for joining me once again. As I said just a minute ago, the first quarter is now over. So let's take a look at how the markets have fared. The S&P 500 is down 4.62%. NASDAQ is down 8.84% for the year. So all the major averages are down this quarter. And this is the first quarter of negative decline since March of 2020. So, you know, if you're new to investing and this is your first negative quarter, just take a deep breath and go, hey, is this what I feared? Maybe it's not as bad as you initially thought. So the NASDAQ being down 8.84%, remember the NASDAQ is mostly technology stocks. It's down 8.84%, but 3 weeks ago it was down almost 19%. So we have gained some of those losses back already. But when you look at some of the best and worst stocks of the first quarter, obviously, you know, the best stocks are all going to be the oil stocks, right? The Ukraine-Russia crisis has obviously pushed those stocks way up. So you see a lot of the big oil stocks making the greatest advance during the first quarter. But you look at some of these, some of the worst stocks, and you look at some of these declines. I mean, it's just brutal. So a couple of the ones I follow, PayPal being one, and one that I personally own as well, and I still own it after this decline, down 38% in the first quarter alone, which is, I believe, the worst quarter they've ever had. Meta Platforms, which is better known as Facebook, but of course they changed their name, they're down 33%. You look at some of the other ones, Carrier, the air conditioning company, down 15%. But Etsy takes the cake. Etsy has a first quarter decline of 43%. So that is a pretty brutal drop in 3 months. Something that is painful no matter how much you look at it. When you look at Facebook or Meta, that first quarter decline of 33.2%. When you look at their market cap, right, the entire value of the company, they lost $317 billion in market cap. So, but if you have, again, as we talk about over and over again, if you have a long time horizon, this could present an opportunity for you to be able to pick up shares of a good company if you believe that their future is going to look pretty bright. And so, I discussed a couple of weeks ago, we talked about McDonald's, and we had a conversation about how when the Ukraine-Russia crisis happened, that they went from, I think it was $267 a share down to $222. And I said, man, I just think that's overdone, right? Because 4% of their 4% of their sales come from Russia, which was $900 million a year, if my memory is correct. But it shaved off a ton of market cap of them. Well, you go back and you look at McDonald's right now, and it's already come back up from 222 to 250, right? So now it's down from 267 only down to 250. Now it's recovered. And so when you start looking at some of these, you're never going to quite be able to time the bottom on things. And so you look at Facebook, Facebook year to date, it started the year at $338 a share. The lowest point that it hit on March 14th was $186, and now it's all the way back up to $224. So if you walked into the fire a little bit on some of these, you're not quite catching them at their, if you caught them close to those lows, you're not feeling too bad about yourself. Some of the other ones that got beat up was DocuSign. Let me see where DocuSign was. This is one of those I kind of get mad at myself. So they started the year at 157. They dropped down to 73, and now they're back up to 108. Now, year to date, they started at 158. But when you look at, where they were last year, last August, they were at 300. So they had a major decline right before the end of the year, and then all of a sudden went down. This is one I actually bought some at like $74, like really close to the bottom, and I didn't buy enough. And so, of course, this is hindsight bias, by the way. Hindsight's always 20/20, right? I should have backed the truck up. I should have bought more. And so you're always going to feel that way when you were correct for a certain period of time. But really, I mean, this is a good lesson. Who knows what the future is going to bring in the market. But again, if you have a list of good companies that you want to go after, you got to be brave when the market gives you an opportunity to do that. And so it's just a great lesson in seeing how the market can recover a little bit, even though it's still down for the year. But it's also a great lesson in you really don't know what's going to happen. I mean, this quarter shows you how hard it is to day trade. If you're trying to predict what's going to happen day in and day out, I mean, it is just a brutal, brutal task. And it shows you why, only 5% of day traders make money. I mean, it's a very small percentage. And if you jump on the internet, you'll be able to see all of them because they love to talk about how great they do. But man, is it so much easier to just buy into good companies and let them do the hard work for you. But you got to be patient, which we're not always patient, and you got to be disciplined, and we're not always disciplined. So it's much easier to try to be disciplined for a day or two and make a couple trades and feel good about it than it is to sit there and own something for many, many years. So, but we'll see. I mean, we still have the inflation. Question on there. The Fed is going to be raising interest rates for the rest of the year. When you look at what's going on with that already, so some of the numbers, since mortgage rates have moved up in the past month, the number of people that are refinancing their mortgage has dropped 60%. 60%. I mean, that's a huge drop. So, as interest rates go up, people are able, they're not able to afford as much house as they were before. So, we'll have to see how that works out, but it's definitely already having an impact in that particular sector. So, we'll see how that goes. Tesla, breaking news today. Tesla had a great first quarter on delivering vehicles. So, they delivered, I think it was 310,000 vehicles the first quarter. Which has been pretty remarkable considering all of the supply chain issues that they've posted. Elon Musk said it was exceptionally difficult to be able to do this because of supply chain interruptions and China's zero COVID policy, but they were still able to pull it off. So look for that stock to advance again on Monday. It's kind of interesting with Tesla. So this week they had a really good week. What day was it? I guess earlier this week, Elon Musk talked about how they were looking to split the stock again because they want to pay a dividend. And so the stock was at $1,000 before he made that announcement, and then it jumped to $1,088. But the funny thing about that is it increased Tesla's market cap by $85 billion, which was more than the entire market cap of Ford. So just by saying they're thinking about splitting the stock again, you had that massive move. And so we've already discussed that at length, that companies that split their stocks, especially these high price stocks, the Teslas, the Googles, the Amazons, usually the next year they're up 25% versus a market average of 9%. So it does make a big difference. And you've already seen, I think when Amazon made that announcement that they were going to split their stock, they were at 2,800. Now that stock's close to 3,300. So that's a $500 advance just right there. So, you always think you're going to be able to get these deals on stocks, especially when things are looking bad. But, the stocks that are the strongest companies, the most resilient, those are the ones that bounce back first. And so when you get these massive sell-offs, which we had in the first quarter, and especially during, January and February, the stronger companies, the more resilient stocks are usually the ones that are going to come back the fastest. And again, this has kind of proven that again. So one of the other top stories for the week is that you see that the 2-year to 10-year yield curve inverted. So what is a yield curve inversion, for one? Might be something that you're not familiar with. But basically, a yield curve inversion means that you can get a better rate of return on a 2-year treasury than you can on a 10-year. Now, the reason that's called an inversion is because normally when you think of bonds, treasuries, anything like that, you would expect the longer that you go out, the better rate you would get, right? Because you're going to be locked in for a longer period of time. So an inversion is where you have the front end of the yield curve giving you a better rate than a 10-year. So if you can get a better rate on a 2-year treasury, why would you buy a 10-year? You wouldn't, right? You wouldn't do it because you would rather get a better rate now and then 2 years be able to make a decision on where you want to go. The other reason that it's so significant and you see news stories about it is because it's been one of the best recession indicators of the past 100 years or so. So normally when you have the yield curve invert, it means that there's a recession that's coming. The last time we had this happen was in August of 2019. And that one's kind of, the yield curve inverted back then, but, we didn't really get enough data on that one because then COVID happened and that just kind of, took the cake on it, if you will. So, but previous to that was 2005 and then the year 2000. But usually, when you look at 1 year after that yield curve inversion happens, only one time has the market been down, and that was in February of 2000. So, but that also coincides with the 9/11 terrorist attacks. And so, you kind of got to use this data with a grain of salt. There's a lot of things that kind of factor into this. There's not one indicator that's going to be able to predict what's going to happen in the future. But you still have to think about, okay, what's going to, what's my strategy going to be? Am I just going to let, all this short-term data prevent me from making investments? And so, that's the key to, coming up with a strategy of I'm going to put money into the market when I can, and I'm going to be consistent with it because you'll be able to invest when times are good. You'll be able to invest when times are bad, right? So like the past 3 months, if you're working for somebody and you have a 401k or you have a retirement plan, you got to buy shares while they were low. And then as those shares recover, right, it goes back to our dollar cost averaging episode that we had. And so, again, you're not going to be able to predict well what's going to happen in the stock market. So you have to come up with a way that you can control your behavior, which is I'm going to put money in when I can and try to be as consistent as possible. And again, like I struggle with this with my own client base, right? So I have clients who send in, money for their investments, and I'm still amazed because when the market's doing well, they send in money. And then when the market's not doing well, all of a sudden those deposits stop. And it's, so I'll call them, they're like, well, the market's not doing well. And I'm like, this is exactly why you need to keep making those deposits so that we can invest when the market's down. If you're going to invest when the market's high, you got to commit to investing when the market's low, right? And again, it goes from being able to discipline your emotional and intellectual brains and to be able to walk into the fire a little bit. You have to be able to commit to that. If you can't, you probably shouldn't be investing. I mean, it's just one of the disciplines you have to be able to have. And, this first quarter, proves that again. But when you look at the market over the past, 80 to 100 years, one out of every 3 years is a negative year, right? 1 out of 3. Pretty sure I've said that before, but we all need to be reminded of that. But 1 out of 3 years is negative returns. So if you want the good years, you got to be willing to, plant some seeds during the bad years. You got to be willing to invest when you don't want to invest. It's great to invest when everybody's making money and the stock market's going up every single day, but you got to be able to commit during the bad years too, because those are the years where you're able to buy shares that make those good years that much better, right? And you're able to have those dividend producing stocks buy you more shares when shares are low. And then later on, all those shares are worth more, right? So you got to commit to it. And there's something else about those dividend paying companies that we haven't really discussed, but I want to kind of share something with you. So it's always dangerous when you decide to do math on a podcast, right? So you're going to have to hang with me a little bit on these numbers. But the longer you own a dividend paying stock, especially one that increases its dividend, the more money you make, the better your yield gets. So for example, I'm going to pick Lockheed Martin. It's one of the best performers of the first quarter. Obviously, it's a defense stock, the largest defense stock in the world, largest defense contractor in the world, excuse me. And so I want you to look at what has happened with Lockheed Martin over the last number of years. So let's say you buy Lockheed Martin back in 2014. Okay, so if you were to buy Lockheed Martin 2014, it would have cost you around $180 a share. And back then they were paying $5.49 in the form of a dividend, which is a 3.05% yield, dividend yield. Well, Lockheed Martin has a nice history of increasing those dividend payments. And so today, Lockheed Martin pays $11.20 a share, right? So that's more than double what they paid back in 2014. Well, if you bought your shares of Lockheed Martin back in 2014 at $180 a share, those shares today are now worth $446, let's say. And the yield, when you look at that $11.20 that they pay, that is a yield of 2.54% on the 446. But you didn't buy it for 446. You bought it for 180. So your dividend yield, if you bought it in 2014, would be 6.02%. That's what your dividend yield would be because you bought the shares years ago and you've been able to see those dividends rise. And that is one of the key concepts of buying good dividend-based stocks, because especially the ones that have a history of increasing their dividends. Because as they increase their dividends, that raises your dividend yield, but it also acts as inflation protection for you because they're going to keep raising those dividends over time. And that's something that most investors do not realize. And of course, when they're looking at their screen, even if they bought it in 2014, it's not going to give them the dividend yield of the price they paid. It's going to give them the dividend yield of where the stock is now. So computers are smart, but they're not that smart. And you got to be, willing to kind of keep tabs on that and say, hey, I'm doing better on these stocks than I thought I was. Right? So when I'm dealing with clients or I'm working with clients, this is something I constantly bring up is like, hey, your dividend yield is actually a lot better than you think it is because you bought these shares so many years ago, and the increase in the dividend is happening at a faster rate than you probably realized. And so it's something you have to kind of keep reminding yourself, because that dividend of Lockheed Martin, yes, it's grown. Now it's $2.80 a quarter. And back then it was $1.33, but it was kind of a slow increase. So it went from $1.33 to $1.50 to $1.65, $1.82, $2, $2.20, $2.40, $2.60, $2.80. And so, they're raising that dividend, and you notice, but you don't really notice because it happens slowly. And that's the way it works with a number of different companies that have this history of raising their dividends. So when you're doing your own research on stocks, especially ones that pay dividend, go in there and look and see how many times, how often do they raise their dividends. But that's going to be one of the keys for you when you're investing in a time where inflation is rapidly rising. You want to be able to invest in companies that also raise their dividends to help you fight off that inflation. And also when the market isn't doing well, kind of like this quarter, when the market isn't doing well, having great companies that pay dividends, that basically pay you to wait, right? You're basically being paid to wait for the market to recover, for companies to start doing well. It makes it a lot better than when you own, a company that goes underwater that you're losing money on and doesn't pay you any kind of dividend to wait, right? So that's why I'm so much more aggressive on stops with companies that don't pay dividends versus companies that do pay dividends. So there's your little dividend lesson for today. So as I wrap up this quarter one review, I gotta just put some questions out there to you, which is, how'd your first quarter go? How was your discipline? How are your habits during this first quarter for all the goals that you set for yourself for 2022? And this isn't are you accomplishing what you wanted to accomplish or not session. It's just more of, you got to be able to control the things that you can control. And the things that you can control are your daily habits, your daily disciplines. When you look at the goals that you set for yourself, we can't always control the result. And especially in investing, obviously, we'd love for stocks to go up all the time. We'd love for them to be hitting all-time highs, but you just can't control all that, right? So, have you been doing the things that you set out for yourself? If it was reading a book, if it's exercising, if it's meditation, if it's, you wanting a new job or you studying for an exam or whatever personal goals you have set for yourself, I hope you use this weekend or at least, a couple days, but you got to sit down and you got to look at it and you got to say, okay, after the first 3 months of the year, where am I at? Right? And you don't have to tell us. This is just a conversation between you and you. You're just competing against yourself, right? Just competing against yourself. But where are you? What are some of the things you could be doing better? What are some of the things that maybe you might need to refocus on, right? And so just kind of take an honest look at it. Some of the things I'm most happy about is I was able to take a couple trips with my family. I was able to have that quality time and with some of my extended family as well. And that's important to me. So being able to do those things, my business is doing well, podcast is doing okay, like all the different things. Where am I lacking? Well, I got the Berlin Marathon coming up in October. I didn't run as much as I wanted to the first quarter. I just can't keep up that pace. And so now I'm like, okay, it's past spring break. Second quarter of the year, got to get my miles up every week and got to get back focused on that. So, we're all going to, when you start to look at your goals, we're going to have areas that we did really well in. You're probably going to have some areas that you want to improve on. And so this is a good time. It's a good weekend or next weekend to just sit down for an hour and just look at where you're at. And so you can also start to look at where you're at, do a little self-assessment, be reflective. And then you can also spend a little bit of time and go, okay, for the next 3 months, what do I want to work on? And so sometimes it makes it a little bit easier when you break it down into smaller pieces. When you look at 3 months at a time versus the next 9 months, just say to yourself, okay, when I have this conversation with myself on July 1st, what are some of the things I want to have done? And so just allow yourself to be, to kind of be honest with yourself and to kind of look back and reflect a little bit. But also, if you had some successes, take the time to appreciate the fact that you put in the work to have some successes and just, congratulate yourself for the accomplishments you had, but then also say, okay, this is where I need to be if you're not on track on something that you want to be on track for. So I hope that helps you. I hope you had a good first quarter. Here's to a better second quarter. And let's all go have a productive week. Never mistake activity for achievement. And I'll see you next time.